Hey guys, welcome back. The title of this video is going to be the bait and switch stock market. The bait and switch stock market. In one of my previous videos, I talked about the bait and switch technique that high yield savings accounts, they do that, right? Sometimes to get you in, right? They bait and switch you, giving you like a 7% yield, right? Or whatever. Well, the stock market does the same thing, and you gotta be careful about it, okay? Now the stock market, let's talk about that for a little bit. It's run by computer algorithms, okay? This is where companies, hedge funds, money managers, market makers, all these big firms, big banks, they have a ton of coders and smart people building algorithms to bait you in to buying a stock or selling a stock at the wrong price, okay? They've been doing this for 100+ years, right? Since the big financial crash of the 1929 or whatever. So they know the games that are played, right? These algorithms, they know where people are buying and selling, all right? So when a stock is going to the moon, they're pushing the price up. The big banks and the algorithms. They're pushing price up, they're pushing price up, okay? And they're waiting for a signal. They're waiting for a signal to bait you in. And what is that signal typically? It's usually a high amount of volume. They're determining, oh, how many retail and how many other investors are we pulling in to the market based on volume and price action, right? They have the history to know what's going on. And so what are they going to do? When they bid that price up all the way, they're going to get all these people to pile in. And then they're going to trim. They're going to sell. They're going to create a peak, and then that peak is going to start selling off. And you know what's going to happen? They're going to stop selling. And then retail is going to start selling, and other people who are fearful of the markets, they start selling, and they're taking profits or they're taking losses. One of the two, okay? So you got to be aware of that. It's a bait and switch. They bait you in to the upside, and then they sell. They switch. They go to the downside, okay? And what happens along with the algorithms is they might actually just, kind of talk behind the scenes, right? They might put out a few news articles, right? They might tell the news, the media, hey, put this story out about the market. The market's not doing so hot, right? It's going to start selling off. That's what happens, right? And then when you get this big push, downward push, the market makers and all these algorithms, they'll start selling the market. They'll start going short to the downside. They'll push it down. They'll push it down. Okay, and so what happens then is you get a bunch of short sellers. They start piling in and getting excited. They're like, ooh, man, it's going down. It's going down to zero, right? And so they start selling. They borrow shares and they sell to longs. They sell. And when the volume profile gets so big, all the algorithms, they see this volume come in. Right? It's a liquidity event. People are selling and more people are buying. So what are they doing? They're baiting the short sellers in, and they switch. They switch to the upside. They probably put maybe a couple media stories out there like, oh, hey, things are going good. The market's doing good, right? And they kind of key these rhythms with big events. They have scheduled economic events like the Federal Reserve. They're making dates on, oh, well, the interest rate's going to go up here or it's going to go down here. And the algorithms are going to play the market like that so that they can get these big bait and switches, all right? And these things take time. It's not quick. When you look at a stock market in general, especially the S&P 500, it takes months for these moves to happen. It's not going to happen in a week. You might get a week down where you might get a little pop, a couple buyers come in, but then they'll keep selling the market down to bait short sellers to pile in. And they'll do the same to the upside. They're going to bait people who don't understand the market to buy the top, right? To FOMO in, right? Fear of missing out. And that's why people who do DCA, dollar cost average, they win. That's why longs win, because they don't play that game, the up and down valleys, the swing trading. Now, if you know, there are some swing traders who know what they're doing. You know, you can win in that game, but you better be playing the game that the big algorithms are playing. You better be playing the bait and switch game, and you better understand it and know what you're doing. And you can't do it quick. Swing trading is not quick. It takes time. Markets can rally for a long time. That could be a huge bait and a switch at some point. It's going to happen, right? Markets don't go up forever. They don't. You feel like they can. You feel like, oh man, I'll just buy the high and sell the high. It don't work like that all the time. So just be careful out there, right? The market, it's kind of a bait and switch thing, you know, from the short-term perspective, right? It's all about time with the market, right? The longer time period you have, the safer it is you are. You're not going to be playing the bait and switch game, okay, that the market makers and the algorithms are playing. You want to play the long game, right? Don't get sucked into the bait and switch, okay? So just be careful about that. I thought it's something, I thought about this just this morning, and it was kind of related to that high yield savings account bait and switch video I did. So the stock market has its ways too, so just be careful. DCA in to good quality companies and you'll be all right, okay? So anyways, take a look at my previous videos, and everyone, I just want to say thank you, and I appreciate your time, and everyone have a great day. Thanks. Bye.